welcome to the Q4 2022 edition of the Deloitte Private Debt Deal Tracker. Following a record-breaking H1 2022, a drop-off in private debt activity in Q3 continued into Q4 as a result of ongoing macroeconomic uncertainty.
Private debt deal volumes were down 9% compared to the prior quarter and 21% compared to the equivalent period in 2021. On a semi-annual basis, volumes fell by 16% compared to H1 and 19% compared to H2 2021. This continued drop-off comes amidst a market backdrop of buyer and vendor valuation mismatches and a subsequent increase in the number of collapsed sales processes across the mid-market. Whilst a notable drop-off in deal volume, the asset class did show stronger resilience to the macro picture than the public markets, where buyout and other sponsored deals were down almost 60% in 2022.
Persistent interest rate and inflationary pressures have led to heightened scrutiny on debt serviceability from private debt managers, resulting in an overall reduction in debt capacity by on average a turn to a turn and a half of leverage. As a result, we may see a return of junior capital as borrowers look for more creative ways to reduce the cash interest burden and reduce senior leverage without the need to inject equity.
Following the effects of the mini-budget, Q4 2022 saw France temporarily claim the crown as Europe's leading jurisdiction for private debt deal-making, accounting for 31% of total activity. On an annual basis, French deals rose by 37%, with German activity flat and the UK activity falling by 19%.
Leveraged buyouts and bolt-on M&A continue to account for the majority of deals, however dropped by over 11% on an absolute basis between H1 and H2 2022. Resolving uncertainty and navigating macroeconomic volatility will be crucial to the M&A market regaining momentum through the down cycle. Whilst the demand for resilient cash-generative businesses will remain and continue to attract healthy debt and valuation multiples, we expect more focus on operational improvement and bolt-on acquisitions over the coming year in order to position businesses more attractively when more benign conditions return.
Turning to fundraising, activity in Europe in 2022 was largely unchanged on the prior year at 44 billion euros. However, capital is becoming increasingly concentrated amongst managers with longer-term track records, with the largest funds representing 50% of capital raised for the asset class in aggregate, up 35% in 2021. This trend is only likely to increase, driven by an increasing liquidity burden on LPs, which in turn is likely to drive an uptick in the market for secondary fund activity in 2023.
For a full in-depth analysis, please visit the website or click on the link above.